Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures trading softly this morning after closing out flat in Monday's trade. While the S&P 500 trading near a record high, investors are awaiting tomorrow's CPI print and any updates on trade as key catalysts to drive further gains for stocks. Analysts at firms including Barclays and JP Morgan seeing more upside for U.S. stocks as they expect institutional investors to ditch their cautious stance and ramp up exposure to equities.
Plus, negotiators for the U.S. and China are meeting for a second day of discussions in London. Prior to the meeting, President Trump told reporters that talks are going well, but China is, quote, not easy. Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick are leading the discussions, focused on reestablishing terms of an agreement reached in Geneva last month, including more rare earth shipments to the U.S. and the U.S. removing recent measures targeting certain goods on China, including semiconductors.
And shares of Apple flat on the day following the company's Worldwide Developers Conference, where it unveiled a slew of updates to its various software platforms. Consumers and investors had high expectations ahead of the event after Apple indefinitely delayed some artificial intelligence features that it had announced at last year's conference. Apple's efforts to start an AI comeback at this year's event fell short, with analysts on Wall Street calling it, quote, disappointing.
U.S. stock futures are largely flat this morning as investors await tomorrow's CPI print and any updates on trade as key catalysts to drive further gains for stocks. However, analysts on Wall Street still seem to be positive on stocks, seeing more gains ahead. You're taking a look at some of the pre-market activity, just flat, barely to the upside for the Dow, fractional gains for the S&P 500 and the NASDAQ. And with us being largely basically through earnings season, with only a few that are going to give us some type of insight into the consumer, we'll dive into Smuckers in a little bit as well, because the pantry trade is one area that the economists and investors out there perhaps can both chew on. But all those things considered, with that in the rearview mirror, the need for catalysts going forward throughout the rest of June, where you've got an FOMC meeting that's coming mid-month, and then additionally us awaiting some of the net out of negotiations between the U.S. and China. Do we see, even leading up to that early July 90-day period, do we see more just of the kicking of the can down the road, or do we see actual elements of deals that investors can actually trade on coming to light here? And
to that point, I think it puts into focus some of the questions around a broadening out of the market. We still have the majority of gains coming from a small set of 7 specific stocks, those Mag 7 stocks here. Is that broadening going to turn into earnings growth for those other 493 going forward? But in the meantime, it seems like investors somewhat out to vacation. We've got a relatively muted Monday, Tuesday so far this week, as investors are still awaiting headlines to come out of any of those talks between the U.S. and China. We know that this week they've been primarily focused on sector-specific tariffs as opposed to some of those baseline tariffs. But what stands out to me, Brad, is that not a single investor that you or I have spoken to has said that they're actually worried about the tariff agenda going forward. And that's why we have the likes of Barclays saying, hey, guys, get back into the U.S. investment areas.
You know, just one more thing that I'll add on this, especially when we do, and since we mentioned the earnings season, which is essentially coming to a close, got a few more companies sputtering out. But the early commentary that we're starting to see around the wave of companies, the banks that are going to kick off the next earnings season. You got a note out from Apollo this morning talking about the banking sector. Balance sheet generally in good shape, credit growth positive, driven by lending by large banks here. Delinquency rates, they also talk about peaking on credit cards, auto loans, but student loan repayments could be one big element of all this. A headwind to credit quality and credit growth here. Plus, they also mentioned the trade war and Moody's downgrade have not yet had any impact on the banking sector or credit growth. These all some critical elements to watch as we go into the next few weeks here once they kick off that earnings season early July. Yeah,
that student loan repayment really showing up in the Bank of America consumer checkpoint data, indicating a little bit of softness there, leading to more buy now, pay later buying as well. Let's talk about trade here. Trade talks between the U.S. and China extending into a second day as Commerce Secretary Howard Lutnick says the talks are going well. President Trump also expressing support.
We are doing well with China. China's not easy. I think we're doing very well. They're over there now. I'm only getting good reports. We want to open up China. It'll be a great thing for China, a great thing for the rest of the world.
Top issues of the talks include U.S. technology export controls and China's supply of rare earth minerals. Joining us now on this, Shehzad Qazi. He is China Beige Book's International Managing Director. Shehzad, it's always great to speak with you and get your insights on U.S.-China relations here. Do these talks really just come down to a simple trade of chips for rare earths? And if so, where do we see them kind of wrapping up?
Yeah, I mean, the bottom line is that China wants access to as advanced chips as possible. And we, of course, are heavily dependent on their rare earth exports, and we need access to those. Our car companies need access to those yesterday. But that's where a lot of complication builds into it, because while it's becoming very clear that there's going to be some kind of walk back on export controls by the Trump administration, we really can't be in a position of giving away too much. I think even what's happening right now politically is going to, I think, soon enough become a liability in D.C. For the president.
You know, Shehzad, as we continue to think about the president and the optics of a deal that this administration has clearly tried to make sure that they have surrounding them, whether that be with what came with US-UK at a time where there were heightened concerns already about some of the other trade deals netting out and needing to show a win in some part of the world, even though those talks were basically formulating for years at this point in time. How much of the US-China trade talks could actually just look like what netted out in 2020?
Yeah, look, there isn't, I think, a big deal that is still on the table. I think even mini deals, which I personally was much more bullish about, are increasingly looking very difficult to achieve, as you can see from the fact that they've had to do this meeting out of nowhere in London because the Geneva talks clearly did not yield the kind of results on the US side, at least, that we wanted them to. So I think with China, we have got this ongoing process where it's going to take a long time to hammer out any kind of understanding on the such exchanges moving forward. So I think you might get a little bit of a truce again. Markets may get a little bit of a breathing room, but I would continue to bet on long-term volatility in the relationship. Let's not forget, we are barely at the 6-month mark of the Trump administration. We've got a lot more time to go here. So I think far more volatility ahead.
And of course, last time around, it took the U.S. and China about 18 months to reach an agreement. But we do have a shorter term deadline, which is Treasury Secretary Scott Bessent's requirement to head back to the U.S. because he'll be on Capitol Hill tomorrow for a hearing. Do you think that that speeds up any sort of short term, tiny agreement trickling out of these talks this time around?
There's, they could potentially walk away with some kind of very tactical deal or agreement, or an understanding. Really, formulating this understanding is what's key here. Right? They want to formalize the understandings. Okay, so they could get that done, but in a couple of months here, in a few months here, could we go back to where we are today? We absolutely could. So I think this is a very shaky truce at best if it can be achieved. And the Secretary of Treasury could come back and the talks will still potentially keep on going on. I don't think that our deadline is necessarily what's driving the ongoing conversation.
You know, Shehzad, as we think about some of the moves that were recently made, one of them notably by China yesterday in raising the minimum wage, and I know that this is kind of region by region within China, how are you kind of looking through some of those moves and saying, okay, that's not necessarily a tariff, but it is an increasing of the costs, input costs for production that U.S. companies that do engage in the region and rely on it for production are also going to have to consider?
Chinese production is so heavily subsidized for so many complicated reasons that wage gains, even if these wage increases take place and what they look like and what the phase-in, et cetera, for all of them is, I'm not necessarily sure that it has a massive cost impact up front, because it may very well be offset by a lot of the freebies that the Chinese manufacturing sector has long been used to.
Is any sign of stimulus for the Chinese consumer digestible as a headwind to trade talks? Like, if we continue to hear news of anything that helps Chinese consumers coming from Beijing officials, does that signal to you that China is trying to move away from needing to rely on the U.S. for any sort of support for its economy?
We saw quite a lot of evidence of stimulus in our May data that went out. But here's the thing, it's traditional stimulus. It's borrowing that's being directed towards companies. It's cheap interest rates that's being directed towards companies. It is a monetary policy levers being applied for your infrastructure development side of the economy. So it is continuing to support the supply side more than anything else. And I don't foresee that changing. Beijing is very comfortable with stimulating the supply side. They don't really, I think, even know how to stimulate the demand side, and they're very allergic to doing anything there.
Shehzad, good to see you here this morning. Thanks so much for breaking down what we're all tracking very closely. We know you are too on the U.S.-China trade front. For more on the trade talks, tune into Yahoo Finance today at 3 p.m. Eastern for an interview with Michael Faulkender, who is the Deputy Secretary of the U.S. Department of the Treasury. We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. Time for some of today's trending tickers. We're watching Paramount, Academy Sports, and JM Smucker. Let's first up check in on Paramount, cutting 3.5% of its U.S. workforce as part of its continued cost cutting. The layoffs come as Paramount seeks regulatory approval for its proposed merger with Skydance Media. There you're taking a look at shares. They are flat, moving just barely to the downside here, according to some of the reporting and a memo observed by and seen by CNBC. They say that they recognize how difficult this is and are thankful for everyone's hard work and contributions, but the change is necessary to address the environment they're operating in and best position Paramount for success. That coming from the executives, according to this memo. Also, they had a staff reduction of 15% back in August 2024.
Yeah, I was thinking it's not too significant in comparison. Obviously, it's significant for the folks impacted. It's a little over 500 if you take a look at the percentage compared to the recent regulatory filing from December, where the company said they had about 18,500 full-time and part-time employees. What's interesting, too, is that in a memo that's been reviewed by other news outlets, it looks like the company is signaling that this is just U.S.-based for now, though that could potentially, of course, go a little bit more global over time. And this is just one of the many things that the company is dealing with as they continue to pursue that merger with Skydance Media that's been held up in a legal battle that has ensued, especially following the result of some coverage from CBS during the presidential election. So, of course, we'll continue to monitor those developments for you. Next up here, Academy Sports widening its full-year net sales forecast, accounting for multiple tariff scenarios. Sporting goods retailer topping expectations for the first quarter, despite sales declining from a year prior. You can see those shares up over 4.5%. Another beneficiary this earnings cycle of being able to come out and say, hey, actually, not only are we going to be okay in the face of tariffs, we're going to do better than we had previously anticipated.
Yeah, the company's saying that Air Jordan gave it some wings here. In the statement here from the CEO, Steve Lawrence, the opening of 5 new stores plus the biggest brand launch in the company's history with the addition of Jordan brand are what kind of continued to add to the progress over their strategic initiatives they had mentioned here. There you're taking a look at the year-to-date move here, though. Still a lot of ground to make up for Academy Sports, and this has been an interesting sector within the retail space or segment within the retail space to track, especially knowing the tie-up between Foot Locker and Dick's Sporting Goods. Very competitive measure there, and we'll see how Academy Sports also continues to make its own play very well known to consumers and to its partners in business here. They did say that they continue to see strong growth, though, in traffic from higher income consumers. That's noteworthy. They believe their focus on remaining the value player in their space, though, will allow them to continue to take market share moving throughout the rest of 2025 here. Finally, let's go where the Uncrustables go. JM Smucker issuing a disappointing outlook for fiscal 2026. The packaged food company reporting mixed results for the fourth quarter, with net sales declining 3% from a year earlier. You're taking a look at shares down by about 6.5%. I sent a few questions into the company and their leadership. We've had Mark Smucker on quarter after quarter and have had the opportunity to even go out to Orrville, Ohio, and see exactly what this full operation is about. Uncrustables continues to put this team on its back here, continues to outperform and perform across consumer segments. They had mentioned in response to one of my questions to them, proud of the growth that they've demonstrated on that. Also, though, on the tariff side, they had to acknowledge they said they're monitoring and assessing changes to trade policy and tariffs and working with some of the industry associations and policymakers to achieve the best outcome for their consumers. And then just lastly here, they did acknowledge what they're looking across within the portfolio of sweet baked snacks. And so narrowing some of their priorities around their new leadership and evaluating the product assortment there. It'll be interesting to see what decisions come as a result of that evaluation.
Yeah, that reduced profitability in the sweet baked goods that you mentioned, Brad, a key sticking point in the analyst commentary here. Jeffrey's calling it out. We also had a note from TD Cowen saying that the company provided a big blow to the bull case, surprising Wall Street with guidance coming in here, and that some of the tariff headwinds on coffee elasticity were also a potential surprise. Having said that, they also mentioned that this is a company that tends to guide more conservatively, so I think that's important for investors to monitor, and that TD Cowen describes this as a potential clearing event where you could see investors kind of fleeing the stock, pricing in the impact of tariffs, and then potentially coming back in if you do start to see any retail trends leading to more strength for some of those individual sectors within the company. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Apple announcing significant software updates at its annual Worldwide Developers Conference, including changes to iPhones, iPads, Macs, and watches. Joining us now, Ramon Llamas. He is IDC Research's Director of Mobile Devices and AR and VR. Thank you so much for joining us this morning. Just curious what you make of the announcements that we are getting so far. What stands out to you as the biggest announcement so far?
I think there's two major results coming out of this. Number one is Apple's move for greater cohesion. If you look at its products and more importantly its operating systems, you have one for the Mac, you have one for the iPhone, you have one for the iPad, and so on and so forth. Now Apple's taking that really smart move to bring more closer together, a lot more cohesive than what we've seen in the past. And when you're a kind of a user who lives within that Apple ecosystem, you can shift rather quickly and rather easily, going from one product to the next. And to do so in a way that the experience is just a lot more seamless and fluid and more intuitive. And that's not to say that the current paradigm is not any of those things. Absolutely it is. But it just makes that much simpler. That's going to be a feather in Apple's cap. The other thing is what we didn't see. And what we didn't see is like a whole bunch of steps where Apple really embraces that AI hype. Okay, we know for the last year or so that Apple's been kind of the laggard behind the Googles and the Metas and some of the other companies out there saying, okay, we're not going to be the first, but we are going to take our time. We're going to make it the best possible experience, even if it's going to take some time. So I think Apple's really just positioning itself for future success instead of saying, here, go out and get these OS upgrades and products immediately.
Okay, so it doesn't sound like this is going to drive any massive super cycle.
Not yet. Okay, because remember, this is a developer conference, and it's not so much a device, announcement. But here's the thing, I think Apple made another smart move when I was talking about cohesion earlier, is that when they rename its operating systems according to the year, because we saw, iOS 26, we saw iPad OS 26. That is a really good sign for end users to say, okay, am I on the most current one? And chances are, and this is my bet, that come September, the devices will take a similar route. We're not going to get, iPhone 17, 18, 19, etc. We're probably going to get iPhone 26, 27, 28, and so on. And, going forward, I think it's a small and subtle way to nudge that user to say, okay, here comes the new operating system. How old is the device that you have right now? Maybe it's time to upgrade. So I think, are we seeing anything for the hype cycle? No, but I think there's some subtle ways to get people to move onward and upward to the next device and operating system eventually.
And just curious, if you had a single adjective to describe these updates thus far, what it would be. We had Laura Martin with Needham already calling the event disappointing. What would you describe it as?
It may be disappointing to some because there wasn't any huge whiz bang type of announcement, and I kind of get that. But if there's one thing that I would describe this as a very calculated move by Apple. Okay, if you take a look at that entire AI race, and we can talk about the other companies that are really moving forward and placing big bets. But here's the thing, according to a lot of the surveys that we put together, Joe and Jane Consumer on Main Street USA, they acknowledge the presence of AI on these devices, but they're not really quite there in terms of, what's the value here? What is the point? What am I going to save? How do I benefit? And so Apple, because of its position in the market across multiple devices, taking a very, calculated stance not to rush into things and let all the other companies kind of suffer those slings and arrows of where things go well and where things don't go well, and ultimately what gets adopted. I think Apple takes a very calculated approach to saying, okay, we know AI is there and we're going to be there too, but we want to make sure that this is a very polished and ready for primetime experience before releasing.
As I was looking through the press releases, and ultimately, of course, a lot of our viewers can see a truncated version of those press releases, compilation of the announcements made through a story that was published from our own reporting here. But one of the major things that kind of jumped out to me is how much they're also kind of leaning further into vision. What is the net effect of that, and what we're going to need to see on the device side in order for consumers to gravitate towards that as a viable option? Because the larger question seems like, what is the next device that replaces the smartphone?
Yeah, and Vision OS has certainly influenced a lot of the changes that took place across the different operating systems with liquid glass. Okay, and I think that was a very calculated step by Apple. But acknowledge that the current or most recent device that came from Apple, the Apple Vision Pro, that was not for everybody. That was not for everybody. But it's not difficult to imagine that Apple is going to move forward with it and make some changes to it. And my bet here is that, Vision OS is going to benefit greatly from Apple Intelligence that much more. Okay, to be able to recognize things contextually. And we saw some hints to that. With things like persistence and consistency within that Vision OS operating system. But ultimately, you're also going to need some sort of hardware to do that. And I don't think the Vision OS, the AVP Apple Vision Pro is not the device for everybody. I think that was really for, developers, deeply entrenched, enterprises, and some early adopter consumers. In order to get to Joe and Jane Consumer on Main Street USA, you're going to have to take that device, slash the price, give some experiences that are just much more simpler and intuitive. And by the way, you probably wouldn't mind wearing them out in public. I could wear these outside, no problem. Having an entire boxy headset on, not so much, but eventually, that operating system is going to influence what that experience is going to be, and to have that again consistent from one device and one platform to another is going to hopefully, push further adoption in the years to come.
Ramon, good to see you here this morning. Thanks so much.
Thank you.
As we head to break, take a look at Disney agreeing to pay Comcast $438.7 million to take full control of Hulu. In 2023, Disney said it would buy Comcast's 33% stake in Hulu, initially paying $8.6 billion, and the two companies have been in an appraisal process for the remaining payment since then. The final transaction is expected to close on or before July 24th. We've got much more ahead, including the opening bell after this. There you're taking a look at today's bell ringers. Just seconds ahead of the opening bell, you've got Lincoln Electric. You've got to feel it. It's electric, ringing the opening bell at the NASDAQ. And you've got the New York Stock Exchange live shot of Fortive ringing the opening bell there. And in today's game of who rang that bell, yep, you know who did it. We just said it. Ticker symbol LECO at the NASDAQ, and Fortive ringing the opening bell at the NYSE. as you can see there on your screens. All right, funfetti in the air, claps and cheers like you just don't care. Let's take a look at how we open up today's trading session here. As we were looking at the Dow Jones Industrial Average just after the opening cross, flat just barely to the downside here. A few things that we'll dive into on the components on that in just a hot second, but let's take a look at the NASDAQ composite, things calibrating there. We calibrate higher by about 0.1%, and the S&P 500, that too seeing gains out the gate of about 0.1% as we begin today's trading session. Taking a deeper look at some of the sector activity here early in the opening seconds of today's trade. Financials actually bringing up the caboose. That's down by about 0.6%. And then additionally here, you've got a look at XLE. Energy, that's leading the pack. We've got more gainers than laggards here as we're taking a look at the 11 S&P 500 sectors. Let's also take a brief look at the NASDAQ 100 here. As of right now, we're taking a mixed picture look at some of the mega cap tech stocks, and specifically in those Mag 7, Microsoft and Amazon in the red. But to begin today's trading activity, you've got fractional gains for some of the other Mag 7 stocks: Nvidia, Apple, Google, or Alphabet, Meta, and Tesla. Tesla's up by about 2% to begin today's trading activity. And I promised you the Dow 30 components. Don't worry, this Brad keeps his promises. Taking a look at the Dow 30 as of right now, I'll put this on an equal view. We are relatively split, but it looks like just a couple more laggards than gainers as of right now. We're being led by Boeing Aviation. Take a look at that move at the gate here this morning. That's up by about 2.7%. However, on the other side, you've got Travelers Insurance actually moving lower by about 2.9%. McDonald's Golden Arches got a little rust on them at the gate here this morning. We'll see if they can shine bright as we move on throughout the rest of today's trading session. But as of right now, we're down by about 1.9%. And then just lastly, for all you crypto curious out there, don't worry, I got you covered. We're taking a look at the cryptocurrencies here. Of course, the market's there, don't close. But Bitcoin, over the past 24 hours, you're taking a look at a move higher overall by about 2% here. And this is a longer form chart here let's just put this on perhaps a 5-day trailing view, just so you can see where things have continued to move and hold on to this 100,000 level. And as of right now, 109,000. So we're still off, just barely off of some of those most recently struck all-time highs for Bitcoin. But we'll continue to watch that, as well as the rest of the cryptocurrencies. Ethereum, Ether, whatever you're calling that, call that higher here over the past 5 days, up 13% here today, 24 hours at least, up by about 8.6%. Maddie?
Brad, thanks so much. It's time now for today's strategy session. As investors await key catalysts for stock gains, Wall Street is bullish. Analysts at Barclays and JP Morgan both calling for more gains ahead. So how much upside is there? Joining us now, Michele Schneider, MarketGauge.com's Chief Strategist. Michele, it's great to have you on this morning. Talk to me about what you are foreseeing when it comes to how much more room to run the market has without a clear key catalyst in sight.
Well, certainly the milestone of 6,000 is something that everybody's excited about. And we can see that the SPYs and the Qs are really close to their all-time highs. So that's when I like to watch what I call the inside sectors, actually a phrase coined by Stanley Druckenmiller. And that would be the retail, the transportation, and the small caps. And they have a lot of catching up to do. Currently, if we're looking at IWM, the high was 224. It's trading around 214. Not so bad. Transportation, though, really lagging behind that. And interestingly enough, although retail has been leading lately in those inside sectors, it's still almost 30% away from its all-time high that was made in 2021. So there's a couple of things to be aware of, and that is, it's great to see the growth stocks go, and we've seen this over and over and over again. But we really need to see things that will actually stimulate the economy participate. And of course, that would be manufacturing, most importantly, the consumer, and then how robust goods and services are moving. And we're not seeing that yet. So I'm cautious here in terms of adding risk.
You know, one of my favorite technicals to track is a very simple one, and it's just the moving averages here, especially trying to get a gauge of the 200-day moving averages versus the 50-day moving averages that we're seeing. And as of right now, on the 200-day, this market is relatively split in terms of the companies that are trading above or below. It's almost 50-50, but the 50-day moving average a little bit more weighted to trading above that. I wonder, from a technical analysis perspective, what your key technical indicator is that you're watching right now to really get a gauge of where spirits are transpiring and sentiment within the market.
Well, first of all, I love moving averages, and I love the 50 and the 200. So let's just broaden out that time frame a bit and go to the weekly moving averages. And that's really where I think is most interesting right now. So for example, semiconductors, they're back over their 50-week moving average, and the 50 is above the 200, which is also important. You want that positioning to show more of a bullish edge, and it is. The same thing with retail. It got over its 50-week. That's really encouraging. So I'm certainly not trying to be negative. I'm just trying to look out. And then if you look at the small caps, they're below the 50-week. If you look at transportation, it's below the 50-week. And regional banks are sitting right on it. And I like to look at the regionals as opposed to the actual big banks. And I know you mentioned the financials in the beginning. So, and biotech, by the way, is just under everything. So that has a lot to do to prove that it can come back. That's what I'm looking at, because from a weekly standpoint, we need to get those things back into these bullish weekly phases, and we're halfway there.
Let's talk about the tech sector within that context as well, because if you look at the 6-month price chart for all members of the Mag 7, the only one trading below its 50-day moving average is Apple. How does that frame how you're thinking about those Mag 7 stocks right now?
Well, interesting about Apple, because remember, Apple used to be the thing that led the market, right? So if Apple was up, everybody felt very bullish, and now, of course, it's fallen out of bed for its own reasons. In terms of the rest of the Mag 7, yeah, I mean, it was such a gift back in April after we saw that big washout and things started to come back. And using Brad's 50-day moving average, especially when they were clearing the 50-day moving average, if we're looking at NVIDIA, I'm a little bit concerned about piling in right now in that area. I think there are other areas of the market that are far more interesting to me, that have a much more limited risk and a much greater upside potential.
Mish, while we have you here, I just got a note that came across from UBS in my inbox, and they're talking specifically about stability and how the markets should be evaluating stability in the U.S.-China trade relationship here as negotiations continue to move forward. What most notably would be the needle mover for you to really get a sense of how much the volatility that the markets have had to endure tied to this relationship is in the rearview mirror, and then there's just more of a prospect for stability that some of the larger institutions trading are looking at right now?
Well, I believe that it's already in the rearview mirror and has been. So now it would have to be something really dramatic, like they don't come to the table and Trump goes back to threatening huge tariffs, to shake the market up. I think the market is anticipating anyway, the worst is over. So that's kind of how we're going. The tariffs are there. I think the biggest impact of the tariffs right now is that we haven't really seen how they will reflect in price as we're going into some of the inflation indicators, PPI, CPI this week. And I think that's what you have to keep an eye on, especially since you're looking at a lot of commodities here. You know, listen, if China and US play nice, that would be good for commodities. If they don't play nice, that may also be good for commodities. And that's why I don't like anyone to forget that conversation right now. That's where there is a tremendous potential opportunity. Not only could we see both the market and commodities go up, but we can also see at some point that split. So China's there, but it's more about how cooperative they are and how much they're going to need from us. They've already split to other areas or not, but I'm not too worried at this point.
Mish, thanks so much for taking some time just after the opening bell. Good to see you.
Thank you. Great to see you.
Let's get to the 3 market movers that you need to watch for the trading day. We've got Yahoo Finance's Jared Blickery with more. Hey, Jared.
Thank you, Brad. We got to talk about small caps for the second day of a row because we've got them leading for the third day in a row. But don't count out the large caps. We got some pockets of strength there too, and also commodities. We've got some strength in metals and kind of a mixed board, but also crude oil is looking interesting. So let's get back to the small caps, and I'm going to start with the S&P 600. And this is a year-to-date chart, and I've been kind of drawing this over the last few weeks. This is an inverse head and shoulders pattern, and we're going to see this a lot today. So just kind of keep that in mind. We're finally breaking above that here, not in a big way, but enough to be considered a breakout. And so small caps leading, I think that would be a welcome sign for the small cap investors because they have just been the dogs of the market over the last few years. We had a nice breakout to relative new highs, and then that just kind of sucked things back down, and that was a disappointment for the bulls. But nevertheless, a breakout we will call it. Here's the ARK Innovation Fund, and I'm going to draw this very very similar line in here, but you're going to see that it's gently sloping up. This is the left shoulder, this is the head, here is the right shoulder. This is breaking up even more. That's a year-to-date. Here is the 3-day, up 11.5%, pretty impressive there. And that's kind of in the small cap themes, even though the biggest member is Tesla. Most of them are a lot smaller, although Coinbase is getting bigger. And then also in the ARK space, I want to highlight the ARK Exploration ETF. So this is space, and here we have, this is a year-to-date, and look at this breakout right here. This happens to be a record high. If I put a max chart on, you can see the fund started trading way back in 2021, had this nice cup, this rather big candle, kind of extended to the downside thanks to those tariffs, but nevertheless, it is broken out. So defense and aerospace has been something I've been watching in large caps, but also the small caps, so watch this one as well. Now we got to talk about the large caps. Here's the S&P 500. Let me just dial that back down to a year-to-date, and here we can see, here are those record highs. We are less than 2% away from them, and we are just crawling, inching along here. So if you think it's going to come quickly, maybe think again, but nevertheless, when you see a bull market really expand, that's what tends to happen. You get volatility contracting because you got some things moving up, some things moving down on a daily basis, and rotation is the lifeblood of a bull market. Also want to highlight some of the big stocks in the Mag 7. Microsoft has been hitting record highs recently. It's underwater today, but here's a 5-day look here. Microsoft coming up 3 record highs, and this is a stock that just recently broke out. This is a 6-year chart, and for the last few years, it's just been trading sideways there. Finally broke to the upside, so that is a leader to watch. Also Amazon. Here is my final inverse head and shoulders top that I'm going to show you today. Not quite breaking out just yet, but at the Rubicon, we'll have to see what comes of that. And then finally, we got a little time for futures here. I haven't talked about platinum a lot, and this is just breaking to new highs. You can see it is up 35%. A lot of that coming over the last few days. Here is a 3-year chart, and you can see there, nice long breakout after or nice big breakout after a really long base. Those really long bases tend to extend those breakouts, so I got to think we're going to see higher highs in the near future. Got to skip over silver because I got limited time, but here is crude oil. Let's put a year-to-date. It's not moving very quickly, but it is holding over $65 per barrel. And here's another inverse head and shoulders. Just notice that 65 opens up 70 and 75, just maybe not quickly. And on that note, I'll send it back to you, Maddie.
Jared, thank you so much, as always. We got all your markets action ahead, so stick around. You're watching Morning Brief. Investors will get a fresh read on the impact of President Trump's tariffs on inflation Wednesday morning with the release of the May CPI numbers. Economists expecting consumer prices, excluding volatile food and energy costs, to rise 0.3% during the month. So how big an impact will the month's numbers have on markets and the Federal Reserve? Joining us now on that, Bill Adams, Comerica Bank's chief economist. Bill, great to speak with you this morning. What are you anticipating for the CPI print this month?
I think we'll probably see what's close to that consensus forecast. We're expecting a little bit cooler on the headline CPI because gas prices were down in May. That helps consumers. But I think in the rear view 6 months from now, we'll see that the spring and early summer were probably as good as it got for inflation in 2025. Looking at other indicators like the PMI reports, business input costs are rising at the fastest pace since 2022. And so probably by the end of this year, early next year, we will see CPI picking up to a 3 handle. And that's moving in the wrong direction. That's not moving closer to the Fed's target.
And so how far in advance of that do you expect the Fed to take what, at that point, if we were to see a 3 handle on it, what might be looked at as preemptive or proactive type of action?
I think the Fed is in a bind right now. The Fed sees that the job market is operating at a slower pace. We're adding jobs slower in the first 5 months of 2025 than we did in 2024, 2023. But the Fed is, I think, more concerned about inflation, given that it looks like inflation expectations have risen. It looks like inflation is headed higher from business surveys. And the Fed had a big miss on inflation in 2022 and early 2023, and they don't want to repeat that mistake. So I think to the extent that the Fed surprises markets over the next couple of months, it's more likely by them saying that they're going to wait longer to cut interest rates rather than by making a preemptive cut.
Let's talk a little bit about the tariff-driven inflation, because it was interesting in the New York Fed's data. We sort of saw a round trip in inflation expectations ticking up and then going back to prior levels over the month of April. What does that signal to you about how much we're going to see tariffs playing into the inflation data this month?
Consumers in that New York Fed survey, great point, Madison, to bring that one up. Consumers are a little bit more encouraged about the price outlook. I think we see the pass-through of the 90-day pause of higher tariffs on China showing up there, as well as just the overall change in tone on the tariff negotiation with all U.S. trading partners. So consumers are feeling a little bit more upbeat, but still seeing higher inflation in the forward view. Consumers, they, like the rest of us, they don't have a crystal ball about what tariff policy is going to be. But the signal has been both from the government as well as from private businesses that we're likely to see somewhat higher prices over the next 6 months as a result of this. I don't think it's going to be an inflation emergency like we saw in 2022, but I think we will see inflation continuing to be a problem for American consumers.
And so it sounds like consumers should just continue to expect businesses to kind of hot potato that cost that they're incurring.
I think some businesses will be able to absorb those costs, but most will probably pass it on. I think consumers will probably over time see the majority of those cost increases. And that's going to translate into higher prices for durable goods, but might not affect cost of food or cost of energy as much, which are more domestically produced.
Final 30 seconds, Bill. Just wanted to get your take on whether or not you've seen taxes replace tariffs as the key policy uncertainty regarding any of the survey data you've seen.
I think consumers and businesses are starting to pay more attention to the tax bill. And I think the idea of tax cuts over time is probably going to displace tariffs. I think we're early in that, but I think over the next month or two that will happen. And I think that will be a boost to consumer sentiment as it does.
Bill, good to see you here today. Thanks so much for the time and insights.
Thanks for having me.
Coming up, we've got your action on the markets. Stay tuned. You're watching Morning Brief. The U.S. Secretary of Health and Human Services, RFK Jr., removing all 17 members of a panel that makes vaccine policy recommendations to the CDC. They're expected to be replaced by new members who are currently under consideration. And here to talk about the potential ramifications, we have Yahoo Finance senior health reporter Anjalee Khemlani. Anj, what do we know? And ultimately, what is the signal to some of the publicly traded companies who rely on some stability within the CDC?
Yeah, we've already seen both the FDA and the CDC go through a little bit of changes. We've seen other advisory groups maybe be fired and brought back. So right now things are a little bit up in the air. But what we do know, especially from some of the insiders I spoke to, is that the CDC Advisory Committee for Vaccines, RFK Jr. is really focused on trying to put in people who will maybe change the tone of how it operates. So just to remind you, the FDA is the regulatory body that approves the vaccine. So the approvals are not currently in jeopardy. And the FDA has its own vaccine advisory committee that helps to talk through whether or not this vaccine is safe and is useful and should be approved. And they make that recommendation to the FDA. Meanwhile, the CDC's panel determines who should be given the vaccine, who is it safe for, who is vulnerable, which populations are vulnerable, and who actually needs these vaccines. That is the panel that just got fired. Could we see some reappearances based on the history of how these firings have been going? Possible. Some insiders I spoke to said that the process for these new applicants is very different. They're actually not applicants. They're being sought by RFK Jr. and his team. And so that really spins what we're looking at in terms of what the purpose of this committee could be. We know that if you take a look at Project 2025, we know that has been referenced multiple times in terms of action from the Trump administration. And in there it says, by statute or regulation, CDC guidance must be prohibited from taking a prescriptive character. And that language does match what we've heard from RFK Jr., a known anti-vaccination individual who has been pushing for rolling back the childhood vaccine schedule and making it more about personal choice, more individual choice, parental choice, and even physician choice about what vaccines kids should be taking. And so it's likely we're going to see that interrupted. I've had conversations also with vaccine companies in the recent past talking about what they expect. And the truth is that while this will actually disrupt the flow of bringing a vaccine to market, we have had some of what was termed the big ones already on the market. And so this is more of what are the new ones, what are some areas that, long projects of bringing vaccines to market are still needed. And it doesn't have a very large impact on some of these vaccine companies. Notably, the big ones in the game are Pfizer, GSK, Sanofi, as well as Moderna and Merck. And so these are the companies that could be impacted in the future as they look to try and bring new products to market. But the fact that there are also companies we've seen in the recent past jump out of the vaccine game also tells you sort of where the needle is pointed in terms of vaccines being a product that maybe aren't as big revenue, aren't as big volume, aren't as big a product for these companies.
Anjalee, thank you so much. Appreciate it. That's going to do it for the morning brief. Join me in the next hour for more analysis on catalysts and Brad for Wealth after that. Stick around.